Welcome to Wall Street Unfiltered. We're going to throw the mainstream gloss out the window. Welcome, or maybe not. And I say this because this podcast has a serious risk disclosure attached. If this were a movie, it was going to be R-rated, and it's for mature audiences, and that's the type of audience that typically follows me. And this is because we're going to talk first about the Greek debt problem, also known as the whisper problem, the Greek derivatives contracts designed by Goldman Sachs, fresh off some fun in the Libyan sun, might be at a risk to implode in a default. The one problem is that no one appears to have any transparency into the issue, and this is an issue that could cripple the world economy again. Why the Federal Reserve in New York City is not demanding transparency into the directional exposure of the big bank derivative contracts, their trigger points and their correlations, I don't know. I don't know why this isn't being asked. Think it through. The U.S. Treasury has already said the derivative problem is too opaque. Didn't the New York Fed listen? There are a lot of people inside the financial services industry who know the situation. And for the government not to have transparency into an issue that could damage the world economy, to me seems a little odd. But we're going to talk this issue through with UN sovereign debt expert and someone who's been on the inside of the international movement and an advocate on an organized basis. He's trying to implement a predictable solution rather than a flash crash solution. Eric LeCompte is going to be our first guest today. Then after that, we're going to turn 360 and we're going to look at investing in prisons for profit. I wrote a few articles about the topic. Bill Gates essentially has no problem with investing in prisons. Bill Ackman, along with myself, admittedly, do have a little bit of an issue with it. But we're going to give someone who favors investing in prisons for profits a chance to make their case, and we'll ask him a couple questions along the way and provide some analysis. Then if we have time, we'll get into some rapid-fire insider talk, and I might have to use some code just for the sake of brevity, and then we'll wrap it up in 30 minutes. That's going to be a roller coaster ride, and again, just to make it clear, this is for mature audiences only. Eric LeCompte is with us. He serves as a United Nations expert on a group that discusses sovereign debt, and he's also executive director of Jubilee USA, which is an economic advocacy organization regarding debt relief. If you've followed any of the work that we've been doing at Value Walk regarding Argentina, and we were consistently predicting that the government of Argentina would not engage in serious negotiations with the holdout hedge funds, and we reported a lot of the behind-the-scenes action, including some of the legal maneuvers. You saw Eric's name quoted quite often. Eric, welcome to the show.
Mark, it's great to be with you.
I want to mention one thing. You have some particularly refined skills because I had sent you an email while you were giving testimony at the UN, and you responded. So congrats to you for having some amazing juggling skills.
Well, thank you. Well, I mean, it's always a pleasure to be able to speak with you, Mark, because you really cover these issues in ways that a lot of people aren't. And for people that care about finance as well as the broader investment community, you know, we're people that greatly care about the details. And too often, the details are lost in the quick headlines we see flash across our screens.
Well, let me touch on a topic that we addressed a little bit behind the scenes, and that's the derivative contracts that underlie a lot of these sovereign debt deals. When we talk about debt forgiveness, that sounds so great, but in some cases, debt forgiveness can trigger a official default on their sovereign debt agreements, and then there's a whole derivatives daisy chain that is by and large unknown in its magnitude, and it's unknown in how the derivatives are connected to one another and where the risk exposure is focused. Talk to me a little about some of the behind-the-scenes discussions you've had at the UN and at the IMF regarding the derivatives and how that fits into the overall debt restructuring picture.
Well, and that's a major issue, and there's no way that we can address the totality of the concerns we have in global finance if we're not also talking about the derivatives market. So, essentially, this kind of market, as you note, takes place behind the scenes. Often, there is no real sense of who is investing in these derivatives, in these kind of this kind of legalized casino on whether other investments will fail or succeed. And so since there's very little knowledge about it, it does often have connections to a more shadowy world of finance. Generally, most governments in the world express concern about how it operates. And after the last financial crisis, it became imperative when the U.S. government looked at legislation like Dodd-Frank and others to try to deal with these kinds of problems. Recently, it became a major problem in Greece and became a problem even for Greece to be able to restructure its debt. And then those same problems we've seen in Argentina. What's really interesting, about this whole question of derivatives is that some investors are essentially playing on both sides of the table, where they will, essentially be litigating for payment in full, but they'll also be placing a bet on whether or not a country defaults. And when they place that bet, they still might end up getting paid in full either way. So it's very high risk. It's very speculative, and I think what we're most concerned about is the hidden nature of it. And because of that, it hides what is very real risk. And doesn't allow that risk to be revealed.
Well, the risk, let's just address it. The derivatives are as much as 7 times the value of the world economy, and no one in government knows exactly the exposures, but it's said to be 75% focused on interest rates and sovereign debt. So if we start to see some implosions or some defaults, there could be a daisy chain that a lot of people I know in government and who have received warnings are very concerned about. But for some reason, the people that write these derivatives contracts are not being required to provide transparency. And providing transparency isn't going to damage the product or necessarily impair the bank's profitability. It just helps people manage risk. I know you're not a fan of Paul Singer, but that's one of his topics that he advocates, is all he wants to do is manage risk. And that's probably one area where you guys might find some agreement, but I know you guys are on the opposite ends of the spectrum in regards to the Argentina issue. Outside of Argentina and Greece, give me the next major country that could get into a sovereign debt default issue.
Well, unfortunately, there are too many countries to name right now because there are so many countries that are dealing with high debt burdens, and several countries are either in the process of starting to restructure their debt or default. So, some of those countries, right now include countries like El Salvador, and even with Greece's high debt burden, depending how the new government deals with that and how the European Central Bank and the International Monetary Fund and the European Union chooses to engage, it could create additional crisis there. I don't think to the level that we saw in Argentina, especially since there are some very strong global voices, including that of President Obama, that's urging all people, all groups that are involved with this to sit together at the table and come up with a good solution. So, this gets us, back to where we began our conversation, as I'm sitting here at the UN today. But it's about the need for an international bankruptcy process and having clear standards for responsible lending and borrowing. Because when these things are in place, they create a more stable and predictable market environment, not only for how small and large economies operate, but also protect our investment.
Well, I wanted to get you to address who the people behind the resistance are, because I'm going to speculate that a lot of people fighting an organized bankruptcy process for sovereign nations are doing so in the shadows. So I think the fight that you have in front of you is not just a fight of public ideas, but you're also going to be fighting a behind-the-scenes war, which is actually how a lot of decisions in financial arenas get made. It's a hard battle to fight, but I hope that you can help keep the world safe from sovereign debt and derivatives fault.
When we're talking about a global bankruptcy process, fundamentally, this is not a new idea. In fact, when we look to the United States in Chapter 9 or Chapter 11, processes like that exist in most countries around the world, and we credit those processes in the United States as one of the primary contributors to stability and predictability in our domestic financial system. But we're actually lacking this mechanism in the international financial system. Adam Smith, who is considered to be the father of modern economics, this was one of the core ideas that he advocated for, that there needed to be some kind of sovereign debt bankruptcy process to deal with these challenges. So as we're speaking today, I'm actually speaking from United Nations headquarters in New York, where the United Nations over the past 6 months has had 3 consecutive votes about implementing a global bankruptcy framework that would be legally binding. You ask the question, what are the concerns about the process, or who might be some of the entities that are concerned about the process? If you look at the UN Hall right now that I'm outside of, with the negotiators and the official delegates who are here to speak about building this legally binding framework, you'll notice that a lot of seats here at the United Nations today are actually empty. In fact, there are many seats that are empty, and unfortunately the governments that are not sitting in their chairs for this sovereign bankruptcy negotiation are the United States, as well as most of the countries from Europe. They essentially have refused to be involved. And it's really interesting, while the United States government and pretty much all of the European governments do support improvements in global debt restructuring, and they support aspects of a global bankruptcy process, they believe that process should be at the International Monetary Fund. They don't believe the United Nations should be having this debate or actually creating a global bankruptcy framework. So at this time, even though those countries support aspects of the process, they are not participating in the process at the United Nations because they believe that any discussions about global finance should only take place at the International Monetary Fund.
Well, you just announced a deal with the International Monetary Fund, and you're making some progress in that regard. Why don't you talk about the IMF bankruptcy relief fund for some of those Ebola-stricken nations?
Well, it's incredibly exciting, and we've been working with the IMF over the past few months, and we actually began this collaboration with the White House over the summer, when we were able to share with the White House that the Ebola-affected countries of Guinea, Liberia, and Sierra Leone were dealing with major debt burdens, and able to share that a country like Guinea spends more on debt payments than it does on public health. It was an issue that the White House took very seriously. Then Treasury Secretary Jack Lew brought the idea to Brisbane, Australia, and asked the G20 to endorse it. In general, the way that the International Monetary Fund deals with financial crisis, or when a country is having a crisis, is they give them loans. So they're still giving highly concessional loans to the countries of Sierra Leone and Liberia. But when they give those loans, they're essentially forgiving some of that debt right away through this new facility, this new expanded facility, which previously had relieved the debt for Haiti, and now they've changed the name and updated it, so it's called the Catastrophe Containment and Debt Relief Trust. And this new facility, what's incredibly exciting, or we're really excited about, is that the new facility in itself is a permanent debt relief mechanism for the world's poorest countries. Debt relief happens too little and too late. And the International Monetary Fund, what they mean by that is that, by the time debt relief happens, by the time there is some kind of debt restructuring, it happens so late, the country doesn't really have an opportunity to get out of financial crisis. So by having these very clear rules in place, when these kinds of countries, these very poor countries, experience shocks, they don't need to go on their hands and knees to, powerful creditors and beg for debt forgiveness. Now there are clear rules on how they can apply and how they can receive it. And of course, debt relief aid is a very special kind of aid because of its accountability measures. By international law, debt relief must go to building social infrastructure. So it's incredibly exciting not only that these countries are receiving this innovative financing, that there's $100 million coming from this trust and another $70 million coming from other IMF member countries that are going to forgive debt over the next 2 years. What's incredibly exciting is that it's now a permanent facility which allows a country to be able to deal with debt at a time when it needs it most.
Well, that's interesting, Eric. Best of luck to you fighting the good fight. Eric, thank you. A lot of thoughts. Let me condense it into one entertaining story that gets right to the point. It's my speculation that right now inside the Fed there are a couple different groups of people. There's an old boy network, the stubborn ones who don't like to face facts. I'm going to speak in code. They rooted for Larry against Brooksley, if you know what I mean. Then there's the Janet Yellen crew of younger, more open-minded people who have a goal to protect the world economy and promote safe, secure market environments. In my opinion, this could be my fantasy. They are guided by more of a calling because they want to guard against potential disaster. The Fed has a group of quantitative magicians, you might call them. They're really using some never-before-seen methods of stimulating markets to try and ensure that things remain stable. The non-transparent derivatives that underlie the world economy could seriously disrupt markets, potentially by 5 to 7 times the value of the world economy. It's a big problem. And here's my question. Shouldn't the quant pros at the Fed, the ones in Chicago and New York, at least have complete access to the directional exposure, the trigger points, and the correlations of unregulated derivatives if these derivative contracts threaten the national security and the national economy? I call this an issue of national security. And if anyone disagrees with me that the derivatives are not a national security issue, call me out publicly. I don't understand why an issue of national security is essentially being ignored by the Fed, as far as I can see. The New York Fed in particular, not the Fed in general. It's the New York Fed's responsibility. So how is it that a narrow group can put itself ahead of national security? Someone please challenge me in the public realm if I'm wrong. You can find me on Twitter at Mark Malin. Now, I've got a little idea. Let's lighten it up a little bit and let's talk about investing in for-profit prisons. We have on the show Ryan Melliker from MLV and Company, and Ryan is a REIT analyst and used to be at Morgan Stanley. Before that, PwC was a real estate consultant. He is involved in what might be considered a controversial industry. It's the prison industry, the for-profit prison industry in specific, and the past may not be an indicator of the future, Ryan's going to want to tell us. So, Ryan, welcome to the show.
Thanks. Happy to be here.
Happy New Year to you, too. Why don't we start by talking about the industry in general, the for-profit industry for prisons, because it seems like there's been a shift. It seems like a few years back there was a regulatory shift. It seems like there's a shift to where this is becoming a more acceptable practice. Can you give us the history of the industry, where it is, and maybe touch on some of the controversies you see that might happen in the future?
Sure. Well, I think, the for-profit prison industry isn't that much different from other for-profit industries where the government has taken a little bit more of a back seat than they have historically. And that's just driven by government budget deficits and things along those lines. I mean, it's not that different than student housing, where you're seeing universities seeing their funding cut, and that is resulting in them choosing to build new dorms via public-private partnerships. Similar thing in prisons right now, where the federal government and various state governments are choosing not to spend as much money on their prison systems, and as a result, they're looking for a third-party provider that might be able to not only develop new facilities on their own balance sheet, causing the jurisdiction to not have to pay for it, but also operate the facilities a little bit more efficiently, which saves taxpayer dollars. So all in all, it all comes down to saving taxpayer dollars. And similar to our views across the general U.S. landscape, there are a few things that we think that the government does better than the private industry can do. So
that's funny. You talk about bringing down costs and efficiencies. You get paid. The prison industry gets paid on a per prisoner basis, and it's this bringing down costs, which, based on some of the reports I've read, is part of a controversy. They claim that some of the prisons are maltreating the prisoners. Some of the prisons are keeping prisoners longer than is necessary. Do you think any of these potential issues or scandals might be a risk to the stock price?
I wouldn't say they're big risks to the stock price. They're certainly big risks to the industry that people need to be aware of. The reality of the situation is, there are always going to be various different parties that will disagree on who the right operator of prisons is, and there are. I won't sit here and argue the moral justification for outsourcing, prison facilities to the private industry. I think that's something that each jurisdiction has to make sure that their taxpayers are comfortable with, knowing the repercussions on either side, whether it makes sense to be private or public. But what I will tell you is that from a cost standpoint, the data that we've seen, which is not provided by one side or the other, but more third-party driven, yields significantly higher operating margins for private prisons and lower costs to the state and the taxpayer. Now what I would say is that there are certainly some challenges associated with it, and the private industry has to operate at similar or better standards than the public side of it. What I would say is that is certainly the case, and Geo Group, which is the stock that we like the most, certainly operates within industry standards, and there is actually there are industry standard practices, and they're defined by the Federal Bureau of Prisons, and every one of Geo's properties meets or exceeds those expectations. So while there might be an argument that the standards are too low, regardless, those are the standards that have been set by our federal government, and those are the standards that the private industry adheres to. And I don't, maybe the standards are too low, but the bigger issue isn't the fact that it's the private prison industry that's operating too low, it's that the standards might be too low. And that's a whole other issue that the unions are afraid to go after, because then they can't justify the fact that the private guys do a better job than the public ones.
So the message I'm getting out of you is, if government wants the standards by which the prisoners are treated to rise, raise the standards, because you guys are coming and meeting the standards. Let me address a different topic and sort of a different question regarding the acceptability of this investment in the institutional world. Bill Ackman was in Chicago recently, and he was telling the story of how he got out of for-profit prison investments because he had difficulty with it on a moral basis. He's part of Project Innocence. And then on the other hand, you've got guys like Bill Gates, who I think might be a geo-investor. I'm not sure. But so there's, a divergence of opinion among institutional investors. What have you found when you talk to an institutional investor? Are they open to the concept, or have some expressed problems with it?
I would say 90% of the institutional investors I speak with are open to it, but then there are a handful that are not. There's one portfolio manager that I talk to rather frequently that says he won't invest in prisons, he won't invest in strip clubs, and he won't invest in casino companies because he believes they're all social ills and he doesn't want to profit off of them. I respect that. I think that makes a lot of sense. I don't think the majority of the institutional investor world feels the same way. I think 3 of the top 10 highest volume stocks on the New York Stock Exchange are MGM, Wynn, Las Vegas Sands, which are all casino companies. So I think you've got, you certainly see the majority of the institutional investor base is much more open to it, but there are a handful of investors that do feel the other way.
Okay, well, let's talk about returns. And let's talk about returns, and also let's potentially overlay it with regulatory risk, because that's one of the big issues that you hear when people are analyzing a for-profit prison stock. Can you give an investor a sense of what kind of returns they might have experienced, in a basket of these prison stocks over the past couple of years, and where you think the future is headed?
Sure. Well, what I can tell you is that there's only two prison stocks right now: Geo Group and Corrections Corp. I cover Geo Group, not Corrections Corp. Geo Group over the last 5 years has generated total returns of 229%, and Corrections Corp of 192%. So that, just to put it in perspective, would compare to the broader market, the S&P 500. That over that same 5-year period generated 109% return. So they've materially outperformed to the tune of 2 times as much growth. I'm not a believer that past performance is indicative of future performance. I tend to think that companies change, they evolve. Stocks are driven by expectations and where those expectations are today versus where we think they'll be a year from now. If they're higher, the stock's going to go up. If they're lower, the stock's going to go down. I think you had very soft expectations 5 years ago, and as a result, the stocks have performed very well. Going forward, expectations have risen a little bit, but as you mentioned, the real driver of expectations in this space has been uncertainty surrounding regulatory reform and regulatory risk. The reality is that each of the prison REITs is, in essence, a contractee of the government, and the government, whether it be local, state, or federal jurisdictions, need to hire these organizations to run the prisons for them. And if they're not willing to hire them, it becomes an issue. If they decide to make material changes along the lines of sentencing reform, which we've seen happen in places like California, it can dramatically reduce the need for prisons. And if it reduces the need for prisons, then the prison operators and the private prison industry will have fewer people.
That's the number one risk I've heard people discuss, is reducing the need for prisons, particularly nonviolent offenders, drug offenders, that aren't necessarily considered a material risk to society based on physical violence. The cost of housing a prisoner, I think, is upward around $40,000 a year or so. It just doesn't make sense on a benefit analysis standpoint. So that's the detraction that I hear the most. What's the detraction that you hear the most?
No, I think that's probably true. I think there's a general view that the U.S. prison facilities are over capacity. I think the federal facilities were at 133% occupancy levels, meaning they're occupied by 33% above the capacity that they were designed for. Now, the design capacity is not a hard number. It's not it's not like there are this many beds. They can add more beds, and they've got enough space to accommodate those beds. But it does create a challenge that clearly we've got more people in these facilities than is necessarily needed. Now, I think that's a very good point that, we might see some changes there, and I think that's one of the things that's most interesting to us.
Okay, let's talk about that. And, we're coming to the end of the time here, so if you could give us, you've put some forward-looking guidance in a research report, and you have some deep thoughts on this. Give us a sense of where the future is going. What's it going to be in a year, 3 years from now?
So I wouldn't be surprised to see some incremental sentencing reform materialize, but I think it's going to be primarily in the jurisdictions where you have overcapacity, where the state of Illinois is at 150% capacity, North Dakota 150% capacity, California, which has been enacting sentencing reform, is at 140% capacity. And what's most likely to end up happening in those states that are overcapacity is we'll see instead of a 10-year sentence for a particular felony, it might be a 5-year sentence plus 5 years of electronic monitoring or halfway housing or day reporting centers. You're not going to go from 10 to 5 and be done. It'll go from 10 to 5 plus 5 of something else. And what's interesting with GEO is the largest operator across the country of non-residential incarceration. So they make the ankle bracelets, they do the halfway houses, non-residential reporting facilities, all of those. So when we see that sentencing reform, what we tend to think is that it's actually can end up being more of a positive for GEO than people realize, because people are focused on the headline risk, which certainly exists. We think it could pressure the stock in the short term, but long term it actually helps their cash flows. And then on top of that, excluding California, which has undergone a sentencing reform already, they're only about 4% exposed to those jurisdictions that are materially over capacity right now. So we don't see as much risk on the top line from sentencing reform for their revenues as somebody might fear.
GEO Corp, I never thought I'd say this, but it's an end-to-end provider of profit potential based on prison from start to finish, and then once they get out. Ryan, it's been fascinating speaking with you. Thanks for your time, and best of luck to you in the future.
All right, thank you.
Now I want to make one thing clear. I am not a prison stock analyst. That's not my specialty. But I will say that if I had to analyze this situation, I would say that this group might be in for a little more regulatory scrutiny. And I think that if certain standards change, the companies that are the most flexible at adapting to what the regulators are asking for, I think will be the winners. A couple quick points. If you were in on the Allergan claims situation relative to the lawsuit that was filed, that's still a good-looking trade. I don't know of the hedge funds I talked to who exactly picked it up. I know it was a little out of mandate for most of you, but from what I've heard, the claims process is proceeding. I don't anticipate a trial, and I also don't anticipate a lot of reporting on the issue. Crude market looks like it remains manipulated, I guess is the best way to put that. A thin blue line that both Singer and Icahn pointed out is very interesting. It looks like a market inefficiency. That small of an adjustment along the thin blue line should not have generated such a violent move. So I think once markets stop being manipulated or apparently manipulated, that'll correct itself. Also, I hold to my rate projection. Yellen will raise interest rates in 2015. The needle will come out. The needle will not come out in 2016. And if she waits much past then, it's over.